As we discussed last week, there are two basic types of biases, cognitive and emotional. This week, we'll dive deeper into different cognitive biases, of which there are two basic types, so-called belief perseverance biases and information processing biases. So as the name implies, a belief perseverance bias is the tendency to cling to one's previously held belief based on a firm understanding of your own abilities, sense, or ideals, even in the face of contradictory evidence. Information biases have to do with how people process information in financial decision making and so often get it wrong. So let's dive in. Maintaining a certain view or belief in spite of new contradictory information is called a conservatism bias. Investors with conservatism biases often overweight initial beliefs about the outcomes and underreact to new information. For example, suppose you buy a drug stock expecting it to soon announce a regulatory approval of a new drug, and then the company announces a delay in approval. If you hold on to your initial belief without digging into the new information, you may suffer from a conservatism bias. A second bias, a so-called confirmation bias, is when investors tend to look for and notice what confirms their initial beliefs and ignore or undervalue what contradicts that belief. For example, many investors currently believe the stock market is doing well because of the loose monetary policies of the Federal Reserve. So they listen intently to any talking heads that agree with that belief and dismiss anyone that disagrees. So to act as an unbiased investor, you would want to listen intently to both sides of the debate and attempt to make a rational decision based on the evidence presently available.